Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Now, before we jump in, I'd like to ask a question, because we've seen this great rally. We're now at about 3,200, about 200 some odd handles, or let's call it 5% from all-time highs. You know, what do you think? Does this make sense? Is this a culmination of support? Are we seeing enough economic strength to really support this? You know, I have my views, I have my opinions, but we'd love to hear from you. You know, what do you think? Like, is this something that's overextended, or are we just going to continue to go and you're looking to get bigger into, you know, how you're positioned? So now that we've kind of gone through those questions and you know, we'd love to hear your answers, let's just dive right in. So today we're just going to look at, you know, some of the storage across the globe, OPEC, just because OPEC is going to be a big talking point over the weekend. Then we're going to look at some economic data and then really dive into the Primary Vision Frac Spread Count. So let's look at some of these components when we're looking at the DOE distillate fuel oil. So when we look at storage, and this comes down to what is oil demand going to be going forward, you can see that storage is essentially now at the same level from 1982. Now, this is a problem just because we're continuing to see storage, and now refiners have to put the product that they're making somewhere. And right now, they're all losing money trying to put it where they can to store it for a later date. Now, maybe there's some economic recovery where this will start to draw down. Maybe there's something there that will happen. But as the world sits, refiners on a global level are going to have to start saying, well, do I ramp, stay flat, or do I decline? And I think at this point, some refiners in Europe and Asia are going to have to start rolling out some economic run cuts. And when we look at, well, if you're not making money in distillate, are you making money in gasoline? And this just shows you where the U.S. sits with gasoline storage. This is the same case across the board. You know, I could pull up any chart that I want from Europe or Asia. The statements are the same. We continue to be oversupplied in product, which is going to weigh on future demand just because refiners are running out of places to put some of this product. You know, this is the Singapore product, stock product, just to kind of show, look, it's bad everywhere. I mean, we're going back to 1994 here, and we still continue to see the pace of builds increase. The volumes continue to go up, and we're struggling to figure out how is this going to normalize, especially when we had the OPEC cuts that started in May, which when we look at, okay, well, what were the loadings? What did we see? And you could see the drop. You know, we can see the drop start from April into May, and now what's expected for June. So that those last two dots show your drop from May to June. And again, it's not enough. It hasn't been enough. We've had cheating. We've had other things. You know, Iraq and Nigeria continue to kind of cheat and avoid where they should be. But the problem is going to be, where do we go from here? You know, Russia has increased gasoline and distillate creation over the last, let's call it 4 weeks. Saudi Arabia, something similar. So even though we're seeing some declines in oil, we're seeing an increase in refined product, which is putting more pressure on some of these other areas. But we have seen a decline, but yet we haven't seen a residual in terms of, you know, the decline showing up in storage. So now when we look at, okay, well, let's look at OPEC as a whole. You know, how did they do? And when we compare April to May, you can see that there is still some residual. There's still some aspect where Angola was too high, Nigeria was too high, and the cheating continues to roll through. So you can see that there's spare capacity. Like, the spare capacity isn't the problem. It's who is being and adhering to current production. Now, June should be a little bit better than May just because we're getting there. And when we look at the OPEC agreement or the OPEC deal, so first it was supposed to have an agreement which was going to last through June, which was going to be a cut of 9.7 million. Then in July, the cut was going to get less to 7.7. They've agreed to extend that cut for an extra month. So now through July, we'll be at a cut of 9.7. And then the cheaters, Nigeria and Iraq specifically, are going to make up for how they cheated through the remainder of the agreement. Now, that was how they created this deal, and they've decided to now meet over the weekend, which is always going to be fun. Now, when we look at the cheaters and we look at Iraq and Nigeria, you can see the level in which they got away from, like the actual and the target. So this difference is going to have to be made up through the life of the agreement, which goes through 2 years. Now, Iraq and Nigeria cheated before. Are they going to cheat again? My guess is going to be yes, just because they don't have the balance sheet to not cheat. But it's something to consider as we're going forward when we're looking at oil prices, which have essentially now closed the gap from the initial breakdown in March. And when we look at Chinese storage, now the reason why we focus on China is because they're going to come out and tell people how much oil they have in storage, which could be a shock value to say, look how much we bought because we need it to be cheaper because we want to buy more. And this just shows you the independent storage, which is in Shandong. And you can kind of see, we remain at all-time highs in terms of oil and storage, where we can see on a regular basis for a seasonal adjusted level, because it has been higher in January and December. But again, that's a seasonal aspect. So we want to think of this on a seasonal level. And you can see the China flows that have increased. Now, remember, in March, they canceled deferred April, they canceled May, and now they have to go out and make up what they canceled in May because they had delayed purchases. So that's why you're seeing this residual, which is showing up in refinery throughput. Now, when we look at refinery throughput, the teapots have been at about 76.3%, and you can see how big of a jump that is. But all of that has to start coming down just because we have so much product in the market that just isn't draining through. Now that we've gone through some different components of where gasoline, distillate, oil sits, we really have to look at, okay, well, what about demand? What is economic data telling us? And there were some bright spots. Business applications were up. And that the reason why that's important is because the applications is really where the rubber meets the road in the US. Typically, as people lose their jobs, they then are incentivized to start their own companies, to issue patents and to create. And we're starting to see that here as people start to get more comfortable that the economy is starting to open up and there's going to be more opportunity. So this is a bright spot. We can't ignore this. Just like when we look into the manufacturing data in terms of PMI, while it's still contractionary, it's still increasing. Like, it was better than estimates in the sense of, we were expecting about 41. It came in at about 43.1. Which again, that's better than expected. April was 41.5. So there was a certain amount of increase. Things are getting less bad. Let's put it that way. And when we look at, well, what makes it up, you can see some of, it wasn't all great. Like, supplier deliveries is a problem. Like, supplier deliveries is the length of time of getting a product from point A to point B. Now, typically, when the economy is booming, there's demand, so there's less supply, so it takes longer. That obviously isn't the case right now, as there's more bottlenecks, there's more issues. So that's kind of an artificial inflation. But at the same time, it's still not as bad as expected, which is also helping to kind of support some of these moves. But again, it's still contractionary. And the question is, going forward, do you think it's going to get better than it is right now? Or do we kind of find this plateau as we kind of work through, as unemployment is got better, but it's still huge. It's still 13.3%. There's still a lot of underemployment. These are issues that are going to be tackled as we look at, are people going to drive more, and is there going to be more industrial demand? And when we shift to Europe, and the reason why we look at Europe is just thinking about, where does the US send a lot of their distillate? Where do we have trade with gasoline? And it's really into Europe. And that's why when you look at the numbers, again, they went from horrible to now just terrible. And when we look at it from the perspective of PMIs, you can kind of see where estimates were, where things were slightly better versus estimates. But the biggest one is looking at the Eurozone on a composite level, and you can see it's still at 31.9. And again, that is a terrible number. That is a number that is going to struggle. We had a surprising increase in unemployment across the Eurozone. And things are going to remain a problem, which is why you're getting more support in terms of the new EU Recovery Fund. Now, the EU Recovery Fund, it's not everyone's going to benefit. And that's why you have what people have deemed the frugal four, of the ones that are going to benefit the least and don't want to give the same kind of grants. So Sweden and Finland are two examples of countries that have said, look, as it stands, we will not agree to this. We do not want to give this capital that we've earned, that our economies have produced to these countries that continue to spend on an irrational level. And that's why you're going to get this fight back and forth. So even though the US is recovering or starting that recovery process, we think that that's going to languish specifically in Europe. And when we talk about rallies in the US and global markets, you have to talk about stimulus. Between fiscal and monetary, we're at about 20 trillion with more to come, which is about 25% of global GDP. And you can see that between just the ECB, Fed, and BOJ, we have about $7 trillion in stimulus. And you can see where it all started specifically from the ECB in means of support, which is just buying bonds and trying to create this quantitative easing. Now, the ECB was obviously strong. It's about $1 trillion with another 500 billion behind it. But the Fed is the one that's quite awe-inspiring. Here we've had this massive move of about 3.5 trillion with more to come, which is about anywhere from 60 to 100 billion dollars either per week or per day, depending on how Federal Powell is actually feeling that day. And you continue to see the support. And the thing is that liquidity has to go somewhere. And we continue to see rates come under pressure, which is pushing more and more people into equities, regardless of where the fundamentals sit. But like we've seen, there is a little bit of that recovery. The question is it going to continue to accelerate, or have we hit this plateau at this point in time? We've gone through some different aspects looking at the EIA data when we're focusing on refined products. We've looked at OPEC and how things have continued to build even with their cut. And now that we have WTI reaching 40, the U.S. is never one to miss an opportunity. And this is how we're going to look at the primary vision frac spread count and look at, okay, well, what was it last week? What was it this week? And what is it going to be going forward? So when we really kind of look at this, we can see that the frac spread count has now rallied from 53 to 58, and we're going to continue to see this slow grind higher. We have Appalachia, which is starting to approach that 20 number as the view we had that oil was going down, so less associated gas, so natural gas was going to get a certain amount of love. That's still the case, but that could easily start to pare back as we have new production coming online. And when we say new production, we're not talking about new production as in terms of a ton of new completions, but shut-ins coming back. We have about 100,000 barrels a day coming back on from North Dakota or Bakken in general. We have about another 500,000 that will come on throughout the Permian over the month of June. So we have about 600,000 that's going to be added to our current estimate of about 10.2 million barrels a day in the U.S. So you get an idea of kind of where things are going, but let's look back and say, okay, well, where was it last year? Here you can see that on June 7th, we were at about 418, and now we're here at 58. But what does that mean going forward? Like, what are rigs going to do? What are frac spreads going to continue to do? And here we can see the Eagle Ford in East Texas. It's the lowest rig count in the shale era. So even though we've seen some rigs come off, that's going to start to stabilize, but we're really going to continue to work through that DUC count for the activity that's actually there. So we're going to see this increase in production. That's kind of a given at this point. But we have to look at what's going to happen going forward. And that's where things get a little sticky, because even though people are feeling better about the economy, gasoline demand is still down about anywhere from 20 to 30% year over year. Even though we keep getting some gradual increases month over month, week over week, it's still a huge disconnect versus last year. And I think we're starting to see that plateau specifically in the Midwest. And then distillate is a huge question mark as we can continue to see industrial production start to recover, but at a very slow pace, and it's weighted differently depending on what areas we're in. So those are different topics that we're going to continue to focus on, specifically on our Wednesday show when we go through the EIA reports, as well as the other global areas, specifically Japan, Fujairah, and our favorite topic of OPEC. So thanks again for watching. We'd love to hear your view now that the market continues to rally and we continue to go near those all-time highs. We'd love to hear what you have to think. Is this someplace that you're adding, or is it someplace where you're looking to take some risk off the table? So again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Have a great weekend.